Hello and welcome to another daily dose of insights powered by Container Exchange. My name is Christian, and every other day we bring to you the key news, stories, and data points that move the container market. It's a new week. It's a new macro Monday here at Exchange. We're going to look at the key macroeconomic indicators that will move container markets this week. Please excuse the seagulls in the background. And to give you a little bit of guidance, I've just shared my screen. Four core topics here, Monday, Tuesday, Thursday, and then sort of another news segment, real brief. Monday today, all focus on manufacturing, specifically manufacturing PMI, so Purchasing Manager Indices, which is essentially a measure of sentiment in the industry. China manufacturing PMI just published this morning, slipped, but above forecast and still above that 50 points line, which below that signals a contraction. EA, so Euro area, expected to be lower, PMI expected to be lower to come in, while US this afternoon, CET expected higher. So very, very mixed picture across the world, in line with sort of current economic uncertainty. Tomorrow then we'll have the remainder of the PMIs come in, so specifically services and the composite indices across the board, and there also significant deterioration expected, and now across the board. So China, Euro area, etc. Pretty negative pictures there. And then lastly, on Thursday, we will have Euro area retail sales figures come in. Forecast and consensus is another 2.7% slump year over year. That is in line with the previous month's reading, so no real change there, just still negative territory, so to speak. And then in other news, I thought this was worthwhile sharing, just to give you a good guidance for the rest of your week, what to watch out for. Number one, we just resolved, or we are at the cusp of resolving, so to speak, the labor dispute at the US West Coast. There's a tentative agreement that has been reached and has to be ratified now. And now, in turn, Canada it's Canada's turn to feel the heat, as it says here, because port workers just authorized or voted for a strike, and now in July. Three core topics, of course, wages. Secondly, sort of the port workers want to prevent the port authorities to employ third-party contractors, and lastly, they want to reach an agreement for no further automation of ports. If I hear that, of course, that's a big red flag. I think avoiding automation is nothing that can or will be feasible, especially if you want to retain competitiveness versus other ports, terminals in your vicinity, or especially on the global market. So there will be no way around automation, I believe. But of course, you'll have to look at how to build automation, or how to build automated facilities in order to leverage the efficiency of the individual worker, not to replace workers. And then lastly, I thought that was also very interesting to share. It's still early in the summer season here in Europe, but Rhine water levels are recorded at a 3-decade seasonal low. So I remember last year we also already talked about the Rhine River and water levels making cargo shipment, intermodal transportation very, very difficult, restricting capacity significantly there. Now, this year seems to be even worse. Seasonally adjusted water levels haven't been so low since the 1990s. So let's see how this brings. This might result in severe capacity restrictions into the European hinterland. So make sure to plan ahead if you are planning a move into the Central European heartland, so to speak, within the next, I'd say, 3 months. That's it from us for today. Thanks for tuning in. Have a successful start into your week, and talk to you all on Wednesday. Take care.